and welcome to the ultimate guide to mutual funds. If you're new to investing or just want to sharpen your knowledge, this video has you covered. We're going to talk about mutual funds and index funds, what they are, how they work, and how to pick the best ones for your investment strategy. So let's dive in. Now, I will be talking about mutual funds in the beginning. So let's talk about what is a mutual fund. Well, mutual funds are a group of certain stocks. So, what exactly is a mutual fund, you may ask? Think of it like a big investment pool where lots of people put their money together. The pool is then used to buy various assets, such as stocks, bonds, and sometimes even other investments. By doing this, the fund gives you exposure to a bunch of different assets. This makes it an easy way to diversify your portfolio without needing a ton of cash. The reason mutual funds are so popular is because they allow everyday common investors to access a professionally managed portfolio without having to pick individual stocks themselves. Instead of managing your own investments, you just buy shares in a fund and the fund manager takes care of the rest. The big perk here is diversification, and this helps reduce the risk of your investment. When you reduce the risk, you have more places for growth and less place for loss. Now, let's talk about the role of a fund manager is. You're probably wondering, who's in charge of all of this? Now, that would be the fund manager. The fund manager, as the name implies, manages your fund. He's an expert responsible for making decisions about which assets to buy and sell. The manager's job is to grow your investment and help the fund's goal, which might be to focus on growth, income, or capital preservation. If the fund is actively managed, then the manager is constantly looking at the market and analyzing trends and picking stocks or bonds that they will think perform better than the market. But if it's passively managed, like in index funds, the manager isn't trying to beat the market, but they're just trying to track it as closely as possible, meaning they're trying to meet the market. Now, you could use your mutual funds or index funds for the matter for retirement. So, to move on, let's talk about how mutual funds work. So, how do these mutual funds actually work? When you invest in one, you're essentially buying units of the fund. These units represent a slice of the fund's overall portfolio. The value of your investment depends on the performance of the assets the fund holds. So if the value of the assets go up, so does your investment. If it goes down, well, your investment will decrease too. Investors generally make money from mutual funds in three different ways. The first way would be capital gains. Now, capital gains is when the value of the fund's asset increases. Now, this will raise the value of your shares. The second way would be dividends. Only some funds pay out dividends, which are usually earned from stocks in the funds. And lastly, you might also get interest if the fund invests in bonds or some other fixed income securities. If the fund's doing well, those earnings can be reinvested into more shares, allowing you to compound your returns over time. Those are just a few ways you can make, no, those are all the ways you can make monies from funds. Now, but there is different type of mutual funds you can invest in. So, what type of mutual funds are out there? To get started, there's a wide range depending on your risk tolerance and goals. Do you want to plan for your retirement or for something else? For example, equity funds focus on stocks. These funds tend to be more volatile, but they also have potential for higher returns. If you're a bit more risk averse, you might look into debt funds, which invest in bonds. These are typically more stable, offering lower returns but also lower risk. So generally, the more risk, the more returns. There are also hybrid funds, which combine stock and bonds to give you a balanced approach. And if you want something even safer, there are money market funds, which invest in short-term, low-risk securities. Something is better than nothing, right? These funds are usually used by investors who need a place to park their money without worrying about big fluctuations. So those are a few of the mutual funds you can invest in. But there are a few good mutual funds you should invest in. So if you're wondering which mutual funds might be a good fit for you, it really depends on your goals and risk tolerance. For beginners looking for growth and low costs, something like the Vanguard S&P 500 Index Fund could be a great choice since it has really good track records. It tracks the S&P 500, one of the most well-known indexes in the world, and it's an excellent way to get broad market experience. On the other hand, if you're someone who wants to start investing with zero fees or really no fees, the Fidelity Zero Large Cap Index Fund might be more up your alley. But if you're more interested in earning passive income through dividends, you could check out the Schwab Dividend Equity Fund. It's focused on dividend paying stocks, which means you'll get regular payouts. And if you're more conservative and want something lower risk, a bond fund like the Vanguard Total Bond Market Index Fund could be right for you, since it has low risk and a decent amount of returns. Those are just a few mutual funds. Now, where can I invest my mutual funds? This is a very popular question. So, where could you actually go to buy these mutual funds? There are several platforms where you can go, like for example, Vanguard. It's often the go-to for low cost index investing, while Fidelity is great if you're interested in zero fees options. If you want a broader, more diversified portfolio, Charles Schwab is also a solid choice. For those of you who want more customization in your investments, Mvine Finance allows you to build a tailored portfolio. I want to inform you that this video is not sponsored, and these are just my personal recommendations and choices. And if you want to get started as a beginner with no commission trading, platforms like Robinhood or Webull might be the right fit for you. Now, that's everything you need to about mutual funds as a beginner and as an intermediate. Let's move on to index funds. Index funds are a popular investment option today, especially for those who want a low-cost, hands-off approach to investing. So, let's talk about what is an index fund. Well, what exactly an index fund? An index fund is a type of mutual fund or ETF that tracks a specific market index like the S&P 500 or the Dow Jones Industrial Average. So an index fund is a type of mutual fund. Unlike actively managed funds, where a manager picks stocks trying to beat the market, an index fund simply follows the performance of a specific index by holding all or most of the stocks in that index in the same proportions. The key benefit of index funds is that they provide broad market exposure. They're low cost and they offer steady long-term performance. Since the goal is just to track the market rather than beat it, there's far less human intervention involved, making them much simpler to manage and much cheaper for investors. Since unlike mutual funds, index funds need less human intervention. Now, there is an index fund manager too. So you might be wondering, who manages an index fund? An index fund manager. While actively managed funds have fund managers who make decisions about which stocks to buy and sell, index fund managers take a more passive approach. Their main job is to make sure that the fund mirrors the performance of the index as closely as possible. For example, the S&P and 500. This means that they'll rebalance the fund when necessary and try to keep what's called a tracking error, the difference between the index fund performance and the index, really small. The cool part about index fund managers is that they keep focus on keeping costs low. They don't need to do a lot of trading, which is why index funds generally have much lower fees than actively managed funds, such as mutual funds. That is one key difference between index funds and mutual funds. So, how do index funds work? They work in a similar way to mutual funds, but there's also some distinct differences. When you invest in an index fund, you're buying shares in a fund that holds all the stocks in a specific index. So if the index goes up, your investment goes up too. For example, let's say you invest $1,000 into a S&P 500 index fund. If the S&P 500 grows by 10% over the years, your investment would be worth $1,100 before fees. You earn money from index funds in two ways. First, capital appreciation, where your investment grows as the market goes up. And second, from dividends. Dividends all have payouts similar to mutual funds, right? So some index funds include dividend paying stocks, and those dividends are paid out to you, generally quarterly or annually. Now, let's talk about the types of index funds. There are a few types of index funds to invest in. There are different types of index funds depending on the index they track. Some funds focus on the broad market indexes, like the S&P 500, which track the largest companies in the US. Others might focus on specific sectors, like technology or healthcare. You can also find international index funds that invest in global markets outside of the US, or bond index funds, which track bond markets for lower risk investments. These are a few types of index funds that you can invest in. Now, let's talk about the differences between index funds and mutual funds. While both index funds and mutual funds give you diversification, they're quite different in how they're managed, as I've already said. Mutual funds are typically actively managed, where a manager tries to pick stocks to beat the market. Unlike an index funds, on the other hand, are passively managed. They just track the market. The difference is huge when it comes to costs. Since mutual funds are actively managed, they generally are way more expensive in terms of costs. Index funds are much cheaper. They're also more tax efficient, which is a big deal for long-term investors. So now let's talk about the best index funds to invest in. So, which index funds should you consider? For beginners, I recommend something broad and well established, like the Vanguard S&P 500 Index Fund or the Fidelity Zero Large Cap Index Fund. If you're looking for dividend paying stocks, check out the Vanguard High Dividend Yield Index Fund or the Schwab US Dividend Equity ETF. And if you're into bonds, consider the Vanguard Total Bond or Market Index Fund or the Fidelity US Bond Index Fund. So as you see, you have many options to pick from, and it really suits on your risk factor and which one you want to choose. Now, the best platforms to invest in index funds, platforms like Vanguard, Fidelity, Charles Schwab are great options. But if you're into more customizable portfolios, check out M1 Finance, or for commission-free trading, platforms like Robinhood and Webull are solid choices. Me personally, when I first started out, I used Robinhood and Webull. But once you get more uh, advanced, Vanguard is a pretty solid option. So which is better, mutual funds or index funds? The truth is, it depends on your goals. If you want a professionally managed portfolio, mutual funds are great. But if you're looking for low cost, hands-off investment with a long-term focus, index funds are a fantastic choice to look into. For most people, an index fund like the S&P 500 or total market fund is a great way to go. For others, mutual funds might be better. The key is consistency. Keep investing, reinvest those dividends, and let compound magic work its interest. Thank you for watching, and if you found this video helpful, make sure to hit that like button, subscribe, and leave a comment with any questions you have. Thank you, and see you next time. Happy investing!